Good evening, everyone. As Simon said, my name is Olaf Berg, and I'm employed by Sanlam Private Wealth as an analyst. In the presentation this evening, I'll be discussing long-term investing as an investment strategy, as an investment philosophy, and why we at Sanlam Private Wealth employ a value bias when we construct our portfolios. There's a fair bit to get through, so I'm going to go quite quickly at times. Firstly, the analogy I use is that of favorably loading your dice in terms of our investments. Investing encompasses the future. It's all about the future, and in so it's uncertain. It's not a perfect science. It's not a perfect maths. And the best we can do is try and employ a strategy which allows us to make more correct decisions than incorrect decisions, and more decisions which are incorrect, which don't cost us less. Or let's phrase it differently. The decisions we make which are incorrect, we don't want us to cost a lot. And on the contrary, when we make right decisions, we want those decisions to benefit us greatly. How we go about this is essentially buying companies, in the typical value philosophy, we try and buy companies below their so-called intrinsic value, which means we buy companies below a value which we deem to be their fair value. That essentially means that we generally try and price in the assumptions that the market's making when it values any given company, and then determine whether those assumptions are reasonable or overly optimistic, which would mean the price would be too high, or overly pessimistic, which would result in the price being too low. Obviously, we are interested in companies where we deem the market to be overly pessimistic on the future expectations for that company, and hence the price is too low. That's when we start getting interested and start taking positions. Just in terms of the agenda for the evening, firstly, I'll discuss some perspectives on the SA wealth market. There's some quite interesting tidbits there. We'll then move on to value investing as an investment philosophy. We'll discuss why value investing we believe is the best investment strategy. We'll provide some statistical support and some anecdotal evidence why we believe it's the strategy to employ. We will then go on a little bit of a tangent and speak to quality and the notion of quality. And we'll conclude with our SPW's investment philosophy, that's Sanlam Private Wealth's investment philosophy. A conclusion, and then a look at our performance over the years which we've been in existence. So moving on to perspectives. I think it's probably important to note that everyone who is in the active asset management game is trying to achieve the same thing, which is outperform their benchmarks, which generally speaking are either their peer groups or the indexes. So firstly, you've got to believe that the market is inefficient in its nature, meaning that mispricing opportunities exist for you to exploit as an active asset manager. And then secondly, you've got to believe that you can do so better than the other players trying to do the same thing. Because it's, of course, a mathematical certainty that only 50% of assets by value can beat the peer group benchmarks or the indexes, which is essentially the same thing, before costs. After costs, it's a mathematical certainty that less than 50% of the actively managed funds will beat their peer groups benchmarks.
So is that why you call them assets?
Well picked up. You're not asleep yet. A second point to make is that the bulk of the assets, and I'll get to a graph demonstrating that a bit later, are managed by massive teams who are highly educated, highly professional, highly motivated, and hardworking. So it's not the easiest of tasks being able to beat your peers and beat the indexes. And then lastly, it is a crowded trade. Just within the general equity space, and that's only one of numerous categories, there are 246 general equity unit trusts and only 370 listed shares to choose from. So those are just some interesting facts to set the scene. Having a look at the overall industry, it's a 5.9 trillion rand industry with the institutional money or institutional asset managers, and those are largely the pension funds and retirement annuities and the like, comprising 50% of the overall funds. The retail asset managers, which is the unit trust, the typical Allen Greys and Coronations, comprise 17%. The PIC, which is managing the public institutions' money, comprises 20%, and then the remaining 13% is managed by private wealth asset managers like ourselves. If you take these two segments of the pie and you break it up further in terms of the asset managers, you find that 61% is managed by the top 6 biggest asset managers in the country, which, when viewed relative to the overall pie, means that the top 6 biggest asset managers manage 41% of the assets in this country. And then if you add the PIC to that as asset manager, the top 7 manage 61% of the assets in this country. So the wealth industry is quite concentrated amongst the big names in this country, even though there are numerous other players in the game. Lastly, just in terms of the favored choices with regards to which asset or portfolios, mandates people sign, you'd see that the majority of assets are run according to a balanced mandate, around 40%. A further 25% are managed according to an equity-only mandate, and then the remainder is made up largely of fixed income type mandates. So, moving on to value investing, which is essentially the crux of this presentation. Value investing is premised, as I mentioned earlier, on buying assets below their intrinsic values and then holding onto those assets as they migrate towards their intrinsic values. That's the simple theory around any value investing. Unfortunately, although it sounds simple, it's not as simple as what it sounds. Firstly, it's not simply a matter of historical simple valuations like the common price to equity or price or dividend yield that we like to look at, but rather a matter of normalized valuations, which is a valuation based on the through the cycle or the normalized earnings potential of a company. And then often it takes a long time. Markets can be, call it inefficient if you like, or possibly just behind your view for sometimes significant periods of time, which could result in, currently the value players are experiencing this, could result in significant periods of underperformance, which not only costs in terms of relative performance, but certainly costs in terms of assets under management, which drops to the bottom line for asset managers, which means they make less rands and cents. So it can be painful at times, but those who've stuck to their guns have generally reaped the rewards. As I mentioned earlier as well, generally we find that the opportunities arise for value investors when the market generally misprices or underappreciates the long-term growth prospects of any given asset. So generally when the outlook is dim and more dim than what we feel is justified with regard to a certain asset, we find that the opportunity is there to invest at a low price, and in so doing probably and hopefully generate good performance, which is obviously what the game's about. We all want to generate the best performance possible. This is a very, very interesting question, and that is, why do shares deviate from their fair value? Some professionals and professors and academics believe that the market is by and large very efficient and that there isn't any benefit to be had by taking an active stance, and hence the growth of the whole passive industry, the ETFs and the like, the Satrixes of this world. If you believe in active management, you've got to believe that there are some inefficiencies in the market, and you've got to believe that you're able to exploit those inefficiencies. So what lead to these inefficiencies? Because obviously no one wants to be inefficient. No one wants to be the stupid person who's buying high and the stupid person who's selling at the bottom. It's not within their interest, and no one enjoys losing money. And largely the reasons for this are firstly emotions, and then some hardwired irrational behavioral biases or traits which all humans exhibit. And I just touched on a couple here, and I'm not going to speak to them in depth. I mean, this is a presentation in itself, but you get biases like heuristic-driven biases, which is essentially rules of thumb. You get frame dependence like loss aversion and money illusion. Essentially, people don't like losing, so they hold on to their winners. Fear and greed is very well documented. It's essentially half the ads on TV, I think, are from asset managers, and at least 75% of those play on the fear and greed aspect of asset management. The crux of it is that these biases and emotions result in humans making irrational decisions at times, which results in some inefficiencies, which if you play it right, you're able to exploit, and hence some players consistently deliver better performance than the market. Generally, they result in the market, these biases generally result in the market becoming more focused on the short term, and a term we use is we say that the market extrapolates the short term into perpetuity. So the market takes what's happening right now and says, well, this is an indication of what a particular share or industry or sector can and will do forever. And generally, we find that is the reason where the opportunities lie, because we believe in cycles, and industries and companies go through cycles because of simple economic factors. So I'm going to go through a couple of examples just explaining the extrapolation of the short-term operating environment concept to you. I mean, these examples are very commonplace and very obviously prevalent as well. Firstly, let's just look at this graph and explain it. The red line is the operating profit margin. So it's the profitability of, in this case, Murray & Roberts. We know Murray & Roberts is a construction company. It's been through tough times of late. It's had significant share price depreciation, but there was a time when Murray & Roberts was the absolute market darling. So there was a time when it generated very good profits and increasing levels of profitability measured by the operating profit margin. The blue line is the consensus target price, and I'm going to have a dig at my own ilk here, in that the blue line is essentially the average analyst's price for a stock. And you'd see in this case that the average analyst's expectation for the price of the stock moved pretty much where the stock moved itself. So they weren't adding much value, and they certainly weren't taking a decent view of the long-term earnings potential of the company. And then the green line is simply the price. And what this graph tells you is that when the times are good, and we look now in the middle of this graph, and when the profitability is good, the market says, right, this is fantastic. The company is doing well, it's making great profits, and we expect that to continue for a long period of time. This was a unique environment in that there was a lot of construction build happening. Firstly, with regard to the commodities boom and the civil and other work related to the mines. And then secondly, relating to the Soccer World Cup, where we had to build a lot of roads, a lot of stadium, which sucked up supply and pushed the pricing power in the hands of the construction companies, essentially allowed them to price well and attain these increasing margins. So the market at this point said, fantastic, this is great. We're going to price these companies as if this will continue. And at that point in time, the stock price on an intraday level actually touched 100 Rand. Murray & Roberts is now at 10 Rand. This graph is a little bit outdated and it's fallen. So it's 90% down from where it was, essentially the same company. The market was way too optimistic here, potentially, and we believe it to be the case that the market is way too pessimistic on Murray & Roberts at the moment. These are the examples where we find opportunities. Moving on, the same concept, just a different company. We're now speaking about Astral, which is the poultry player. Again, it's a volatile industry. These volatile industries provide the best examples because they've got the most fluctuations in their profitability levels or their margins. Again, what we see here is that the share price and the share price movement essentially moves in lockstep with what the company's profits are doing. When the company's profits are high, the share price is appreciating quite nicely, and so are the analysts, who essentially should be looking through that, or at least providing some kind of insight other than just being slightly above the share price. And the same is true on the contrary. As soon as the profitability falls, the market expects it to continue, and the share price follows suit. Theoretically, if all expectations are priced in correctly, the stock share price would rise by the cost of capital in a straight line. Now, that's probably a little bit of a theoretical approach, because things change, companies' dynamics change, and so forth. But there should certainly not be as much volatility as there is if the market was totally rational. My last example regarding the extrapolation of the short-term operating environment is slightly different, and this time it involves Imperial, the logistics company. Now, this graph is different, so it needs explaining again. The operating profit margin is the same as last time, and it's obviously a measure of profitability of the company. And as you can see, Imperial demonstrated a fair bit of cyclicality, particularly in the period of the global financial crisis. The red line is the consensus stock rating. So it's what the average analyst who gets measured is saying. And it's measured on a scale from 0 to 5, 0 being the most bearish, so then most negative, 5 being the most positive. And again, as you can see, the analysts simply followed the profitability of the company. And when the company was generating good profits, they said, fantastic, we expect this to continue. And they rated the company highly and gave it a good share price above where the share was trading. And when the company had a bit of a wobble, all of a sudden the analysts pulled scared. And instead of saying, well, maybe this is the time to buy because the market's pulled back, they said, well, we're unsure about this. We're going to give this some time. And they pulled back their rating as well. So all of these examples just demonstrate to us and hopefully to you as well that the market is not always efficient. It does not always see everything rationally and does provide these opportunities if you are patient enough and brave enough to take them when they do arise. So this we just did for fun, and you probably are going to have a bit of a giggle or laugh at this because it's fingers pointing straight back at me as an analyst. But what we did, and just follow the reasoning because we've got a couple more backtest graphs in the presentation a bit further on. What we did here was that we split the market into 5, let's call them buckets. In the first bucket, we put the shares which the market rated best, the analyst rated best. And the second bucket, we put the shares which the market rated second best, and so forth. So the fifth bucket is the bucket which the market, or the analysts in this case, least liked. So that would be quintile 5 would be the fifth bucket, and quintile 1 would be the bucket which the analysts liked the most. We then invested these buckets and rebalanced them on a semi-annual basis. So twice a year we rebalance these buckets, and we started this test in 2003 because of data reasons, not going back further than that. And what it shows is that the analysts generally get the poor stocks right. The stocks which they believe are going to underperform actually do end up underperforming. But the stocks which they expect to outperform generally don't do that well. They generally do around average, a little bit better than average. The stocks that do best are the stocks in quintile 4 and quintile 3. So the purple line in this graph and the green line, they're the stocks which are lukewarm. The analysts don't really have strong views about them. It's generally where you should be investing your money if this backtest is reflective of a normal environment. So why value and why long term? I think I did provide some reasons, but we go into graphical illustrations as to why. Obviously, this is not science now. We just this is a little illustration to demonstrate what we're trying to achieve. It's quite a well-used illustration, but it does prove the point quite well. The straight line is the so-called fair value of a company, and the oscillating blue line is the share price of a company. And what we do as active asset managers who employ a value strategy is we try and buy companies when they're trading below the green line and sell them as they migrate up and touch the green line, and sometimes possibly get a bit lucky and hold them till when they go past the green line, although no one professes to do that. Everyone says, no, we take them to fair value and then we look for the next opportunity. The reason why this works is that if you buy something less than intrinsic value and you hold it to when it reaches intrinsic value, obviously the gradient of your line is going to be steeper. So the slope or the change in the share price is going to be more meaningful, more magnified, should you buy a share below intrinsic value and hold it till when it touches intrinsic value. The two important things are, of course, that your determination of intrinsic value is fair and accurate, and that and that you don't see something or miss something which is justifiably results in the share price being well below its intrinsic or your perceived idea of its intrinsic value. All these examples, you'd see that the red lines rise at a faster rate than what the green line rises. And if you can do this for all your companies within your portfolio, you're going to get a slope, which is a steeper slope, a steeper gradient, which means that your share price is changing quicker, which means you're generating better returns. And that's, through illustration, what we try and achieve by employing the value strategy, as opposed to the momentum strategy, where the momentum guys don't really care where the share is trading relative to the green line. They just care if the share is going up or not. But why long term? You know, this looks simple. You just have to buy a company when it's there or there or there or there, because you know that generally it's going to trade back to intrinsic value. So why long term? And long term is because companies don't always, cycles aren't exactly repeating. They don't follow the exact same pattern time after time. And often you might feel as though the cycle is at its worst, but sometimes, for example, in construction now, the depth and duration of this down cycle is unrivaled or never been experienced before. And the same can probably be said about the commodity cycle. We've never, as far as I know at least, experienced a commodity cycle which is as deep as this one and as long in duration as this one. Probably duration is debatable, but in terms of the depth of the declines, probably the most ever. So graphically, you can be wrong for a period of time. You can think you're buying a cheap asset, but the asset becomes cheaper and cheaper, and you start looking more and more like a fool because you've said that the asset is cheap, but it obviously the market doesn't feel the same way. But with time, and if everything goes according to plan, you're proven right, and that's why we pursue the value strategy, but we also have to, in conjunction with pursuing the value strategy, we have to pursue a long-term strategy as well. You cannot pursue a short-term value strategy. The two don't go hand in hand. And now just moving on to theoretical value. And this is quite technical, but broadly taught in most business schools and most universities. And that is, how do you determine the value of the company? And the crux of it is that the value of a company is the sum of the discounted earnings stream or cash flows of a company into perpetuity. Discounting by the cost of capital, but let's not get so technical. The point is that value accrues very slowly. It's not determined by your next year's earnings or the year after that. Value accrues over a significant period of time. And using normal assumptions for equities, we find that after 5 years, typically you as an investor have accrued 20% of your value. After 10 years, you've accrued about 36%, and after 15 years, you've accrued roughly 50% of the value of your investment. So that must tie up with the fact that you cannot value a company on its current earnings stream, but rather what the through the cycle normalized earnings stream is. So what the average earnings stream of that company might be. So moving on to some statistical and anecdotal evidence as to why value works. And I have to introduce a couple of statistical measures, and I'm going to try and keep them very simple, and I wrote them down to keep them as simple as I could. So I'm going to just refer to my notes here. And so the first measure I'm going to speak to is correlation. And in layman's terms, correlation is the statistical measure of how two variables move in relation to each other. It's measured between 1 and -1, where 1 is a situation where the variables move in exactly the same manner. So they're in absolute lockstep with one another. If one goes up by 1, the other one goes up by 1. The -1 is exactly the opposite. So if one was to go up by 1, the other one would go down by 1. That's the first concept. The second concept is R squared, which measures how well one variable explains the other variable. So you have an independent and a dependent variable. The fact of the matter is that these statistical measures are used in describing or determining whether there's any statistical significance behind relationships that might exist. So that's the theory behind us. What we found in summary, and I'll demonstrate it through following slides. What we found in summary is that value certainly matters. When you invest in companies which demonstrate value and you hold those companies, there's an inverse relationship, so they're negatively correlated, meaning that if you hold a company, or you buy a company at a high valuation, you can expect low prospective returns. And if you buy a company at a low valuation, you can expect high prospective returns. The time horizon matters. It's certainly both these statistical measures strengthen with the longer the time horizon is that you choose, and we'll speak to that. And then lastly, perspective matters. And when I say perspective, in this case, I'm referring to trying to identify the company's value based on a normal earnings, the normal earnings power of a company or any asset for that matter. So for example, let's use a practical example. Anglo-American might seem at the moment to be on a very high PE multiple and a very low dividend yield. But if you take its earnings power on a through the cycle basis, you might find, I'm not saying this is the case, but you might find that it actually can demonstrate, can deliver significantly higher earnings and significantly higher dividends as a consequence of the higher earnings. And if you base your valuations on those earnings, you might find that the valuations are cheap. So perspective certainly matters as well and results in a strengthening of the two statistical measures that I spoke to. So I'm going to give you the numbers, but we won't dwell on them very long. Let's just illustrate the point. The longer you go out, the stronger the relationship is. So the stronger the negative correlation is. We're dealing with correlations here. And if you use normalized PEs as opposed to current PEs, you also get a stronger negative correlation. You'll see that in each case, the correlation, except for that one, the correlation is stronger. Regression, it's the same story. The longer you're out, the stronger the one variable explains the other variable. And if you use normalized PEs, exactly the same story is true. So it tells us that value does work statistically, but that it works better if you enable it through time and with the passage of time to do its thing, to unlock the value, so to speak. Graphically, and again, I probably have to explain these, but graphically, I've got two graphs here which tell exactly this story. Firstly, I look at just very simplistic PEs. That's a current PE, so the PE right now. And then on the left-hand side, it's very small. I apologize for that. On the left-hand side, you're looking at 10-year prospective returns from that point in time. And you'll see that there's a very loose relationship between the 1 year. So it's not a 10-year prospective return, it's a 1-year prospective return and the current PEs. There's a very loose relationship, a not very statistically significant relationship between the current buying price or current valuations and the prospective returns. But there is still a negative correlation, meaning that you don't want to be buying when it's high. As you can see, generally lowish returns. And when you buy when the valuations are low, you generally get high returns. That's on the one side of the spectrum. If you move exactly to the other side of the spectrum and you take a long-term time horizon and you use better perspective, so you use a normalized PE, you get a way better fit and way better correlation and a way steeper gradient as well. Excuse me. So we're using a normalized PE, we're using 10-year prospective returns, and you can see that the R squared has become much larger, much more significant, and so has the correlation. Again, it's statistical, but we're just backing up what we believe in through stats and through these with these past three slides. This graph speaks to exactly what I spoke to, but just put in terms of a bar chart. And what you can see on the x-axis is the PE ranges, and on the y-axis, and particularly the red graph, which is the average return for the periods, is the subsequent 5-year price appreciation. And you'll see pretty clearly that as the pre-E ranges increase, so the average prospective return decrease, pretty much without fail. So statistically speaking, there's strong support for value. It just sometimes takes time. Anecdotal support, and to get anecdotal support in this instance, we just looked at South Africa's successful asset managers. And obviously, with carrying on with this theme of long-term, we used it the 10-year, which is the longest available standardized reporting measure to rank the asset managers in South Africa. An important, or interesting at least, takeaway is that over 10 years, 5 years, and 3 years, only 3 of the top 10 which ranked on 10 years managed to be in the top 10 over 10 years, 5 years, and 3 years. So it's very tough to consistently outperform, and very few get that right, if any. Lots of them obviously have got good track records, but get their track records or get their performance in chunks. That's also another characteristic of value investing. So we're going to delve into the individual managers just to touch on the way they value money and see what they place emphasis on in their philosophies. And we find many commonalities amongst the top asset managers. We start with the number 1 over 10 years, which was Ford in this instance, and they say buying at the right price, long-term, and be patient. So you're speaking time, you're speaking time again, and you're speaking price, which is a reference to value. Prudential, prudent value approach, so that's self-explanatory. Coronation, long-term valuation based. I mean, it couldn't be more to the point with relating to this presentation. ABSA mentioned valuation focused. Resco asset managers, probably a smaller one in amongst this lot. They speak to value investing. Alan Gray, the behemoth in our asset management space, but actually been surpassed by Coronation in terms of assets under management. They speak about share price being less than the intrinsic value, which is essentially what value investing entails, and also their slogan is long-term investing. So exactly the two aspects of our investment philosophy which I highlight. Sanlam, our company, but this is referring to Sanlam Investment Management, so it's the institutional asset manager. They speak about pragmatic value, and PSG Asset Management speaks about discount to the inherent intrinsic values. Again, the same theme. Lastly, Kagiso, the story is the same. They're all, without fail, have employed a value approach, and of course, in doing so, have to have been long-term focused. And keep in mind that this is the top asset managers in the country on a 10-year view. So it's not just a flash in the pan. This is the longest measurement period which we can look at without delving deep into individual company records. Okay, I'm quickly going to deviate from the presentation slightly to touch on quality, because often quality is misunderstood and it's a reference to past share price performance when it shouldn't necessarily be so. So we find, particularly with our clients, but also rather broadly in the market, that quality, as I alluded to, when people speak about quality, they refer to companies whose share price has appreciated the most over any given 5 or year period or something along those lines, any sustained period. Quality in actual fact is the ability to sustainably deliver high returns on capital, higher than your cost of capital, through time, and in so doing grow the intrinsic value of your business or the NAV of your business. So we conducted some tests as to how well past winners have done into the future. And so the structure of this testing is exactly the same as the previous back test which we did. So we're looking at how the past winners over 5 years have performed subsequent to that. So In quintile 1, we put the shares which have performed best over the the preceding 5 years, and quintile 2 second best, and quintile 5 is the worst. Again, the outcome was quite similar. Generally, shares which have done very poorly over the preceding 5 years continue to do poorly. Those are probably the shares that the analysts get right as well. They're just not good shares. They generally got poor returns on capital and badly managed, etc., etc. So generally, you don't want to invest in shares which have done very poorly over the past 5 years. But you do want to invest in shares which have done just marginally below average. Quintile 4 far outperforms. So quintile 3 would be your average. They came in second place, and quintile 4, which would be marginally below average, came in first place by quite some distance, which probably tells you that at the point in time when you invested in them, they were completely undervalued. They'd lost favor in the market. They'd become unpopular, and generally their share prices would be significantly below what they ought to have been if the market had taken a more longer term through the cycle view as to their abilities. So, lesson, don't just invest in shares because they've performed well over the past 5 years. What you can, however, do is invest in companies which are able to generate high returns on capital on a sustainable basis at a point in time when they're trading on relatively attractive valuations, probably because something's gone wrong. Generally, there might have been a managerial own goal, as they say, or the industry might be a little bit competitive for a period in time. Cycles persist because people chase the best return. So in industries which do suffer cyclicality, maybe like the consumer environment, the retailers, generally when interest rates rise, you get to pick up these companies like Mr. Price at P multiples of, let's say, low double digits, 12, 10. And when the interest rates come down and the cycle improves for them, they sell at 30 times earnings or 25 times earnings. And that really gives you the big push from a share price perspective, the big uplift. Yeah, the test backed our theory that you want to invest in high return companies at low valuations, because quintile 1 and quintile 2, the best two quintiles came first and second, and quintile 5, so companies which generate poor returns on capital but trade on high valuations, came stone last again. And didn't do very well on a relative basis at all. So the key takeaway here is back companies which consistently deliver strong returns on capital and do so at a point in time when they're a little bit out of favor with the market and hence demonstrate decent valuations. I'm very quickly going to touch on some examples just to illustrate the points. Sanlam is now regarded very highly because it's generated fantastic returns for shareholders. But there was a very long point in time, call it 8 years, where it underperformed the market by 50%. And there were very well documented and believable reasons as to why this company should continue to outperform. And some of those at the point in time was that as an asset management business, which is part of Sanlam, hence where I sit, the independent asset managers were taking all the money away from the traditional asset managers. There was reputational issues and court cases. There was the impact of AIDS, where everyone believed that a great portion of the population would die young and hence have an impact on the profitability of a life insurer, etc., etc. It reached a point in 2008 when it was just way too cheap. Fast forward in the next 6 years, and the share price outperforms by more than 100%, almost 200%. The starting point was too cheap. I'm not going to comment on the point there, but the story has changed significantly. All of a sudden, everyone sees the emerging market opportunities, which was there in the past. People just didn't choose to focus on it. ARVs has changed the game, so that was a difference, which certainly has benefited the company. And then there was also a shift to asset-light businesses, which has improved the returns, which is essentially a managerial heads up, because that's always what you want to try and do in terms of management. You want to improve the sustained return on capital of your business, sustainable return on capital. SAB Very much in the news now, so probably one which is topical. Between the years of 96 and 2003, SAB performed very poorly on a relative basis. It underperformed the market by 50%. It was the same company in essence, so well, it has changed as times have changed and it's been quite acquisitive, but fundamentally it wasn't doing anything really different. The themes were just different at those points in time. It was seen as an old world company. It didn't demonstrate fantastic growth at a point in time when growth was quite strong. It was the SA market was mature and quite competitive with new entrants, etc., etc. Now you can see there's been a significant value appreciation and relative value gain by SAB relative to the all-share index. All of these red lines are relative lines, so they measure the return on a relative basis relative to the all-share index. The outperformance, again, we're speaking 150%. And the story is completely changed, and as of very late, we've had the ABI and our Bush InBev attempted buy, which is still ongoing and imminent, and has pushed the share price up another 20%. So looking at poor quality companies, and I'm going to be very brief on them because we are squeezed for time. Anglos, everyone loves to hate Anglos at the moment because it has been a particularly poor company, but for 30 years, Anglos was a fantastic company, far outperformed the all-share index, and did so because it did well. But it hasn't been good since then. It's underperformed by a tremendous amount. And just keep in mind how the themes change. Without the companies fundamentally changing, the themes change. What the market likes to look at changes. And this is what we always got to be careful for when you're investing, not to get caught up in the theme and get caught up at the wrong place at the wrong time. Truest people say, well, of late they're saying, well, is this really a good company? Credit cycle, consumers' difficulties. History tells us that it's been a fantastic company, far outperformed the all-share index, the red line that is, over a sustained period of time. And just for interest sakes, today went up 10% on the back of a good announcement in terms of the trading environment. It's one of our biggest bets in our portfolio as well. That's why it was in this presentation. Moving on to cyclical companies. No one wants to touch construction at the moment because of what's happened in the preceding probably 5 years or a little bit longer now. But Wilson Bailey has been an absolutely fantastic company to hold if you held it for a very long time. Those numbers are something to behold. 0.2 to, let's say, it's a 10 times outperformance over that measurement period, being 20 years. So we know the all-share index has given you a fantastic return over 20 years, something in the vicinity of 18% compounded. This has given you double. So a really, really good company to hold. Moving on to our philosophy. I've spoken to why you should be taking a value approach when you value companies. I've spoken to why you have to take a longer term view when you do encompass and employ a value philosophy. Now I speak to our philosophy. And quite simply, we describe it as the 3 Ps. Firstly, price, which is a reference to value. Pattern, which is a reference to cycles. We say cycles exist and you have to be cognizant of that. And then perspective, and that's what we spoke to earlier. That's the whole normalized earnings ability of a company or any asset and how a company compares to that. When we calculate our normalized earnings, we apply what we call a justified valuation to it, which essentially means we apply a valuation based on the company's future ability to generate earnings growth. And obviously, we reward those companies which in the future can grow their earnings at a faster rate than companies who in the future can't grow their earnings at a faster rate. So that's what we do. I tell you in this graph why you shouldn't be too reliant on forecasts and why forecasting is extremely difficult. The graph, and let's just focus on the blue line because the blue line is the all-share index and the other lines are just the subsectors of the all-share index. The graph tells you the actual earnings relative to the earnings expectations 3 years back. So in 2007, 2008, the actual earnings for the all share on aggregate were 40 to 50 to 60% higher than what the analysts had expected 3 years back. And these are trained professionals whose job it is to forecast earnings going forward. The same can be said in difficult times. Moving on to 2011, and earnings for the all-share index were 40% lower than what analysts had expected 3 years before, which was probably at the top of the boom, the top of the economic cycle when things were really going along well. Interesting to see, and it's probably very well understood, that the green line, in this case is resources, is by far the most cyclical and very difficult to get right. And the most stable is the red line, which is the industrial companies. A lot easier to be at least within a ballpark figure when estimating future earnings. I did speak to cycles and what the market does with cycles. Just to recap, markets generally dislike shares at the bottom of the cycle and like shares at the top of the cycle. Whilst we understand that, and we understand that theoretically and ideally we'd like to invest at the bottom of the cycle, knowing that the market's going to hate a share there and love a share there. What we also understand is that cycles are not exactly repeating, and you can't just think that because a cycle touches whatever measure you look to determine the bottom, that it's going to stop there. Case in point at the moment is construction. People completely underestimated the depth of this downturn and have been significantly hurt by the share price depreciation of those shares. So what we do is we value the company at its normal earnings level, as I've alluded to many times in this presentation, and base our decisions on that normal earnings level. And in so doing, with the comfort of having the ability to hold for a long period of time, and the comfort that that comes with the knowledge of knowing that cycles turn, that in time the share will appreciate back to those levels and the share price will follow suit. So just to conclude and then touch on our performance, we say that there's a disconnect between pricing based on short-term prospects and value based on the long-term earnings potential, the long-term cash flows of a company, and hence one has to follow the value philosophy if you are serious about generating long-term sustainable returns for your clients. As I think, hopefully demonstrated, value investing is theoretically sound. It's proven statistically and anecdotally to have worked, but does require time and patience. And now is probably one of those points in time where those people who have invested with value investors have to fussbait, as they say, because times haven't been as good as what historically they have been. I've spoken to how we normalize and how this allows us to get a better view of what the true value of a company is, and hence get a better view of when to invest. And another and second last point, very important point, is that when a company trades on expensive valuations, what it says is that the assumptions that the market makes are high. That's why it trades on those expectations. The market is assuming good returns or higher levels of profitability, strong growth, etc., from the company. Generally, it's hard to live up to high expectations. You know, they say the secret of life is low expectations. Well, the same is true for lowly valued companies. They got very low expectations priced in. So we generally stick clear of the companies demonstrating high expensive value and stick with those which are lesser loved, and it's done us well. So we will endeavor to deliver long-term outperformance by actively managing portfolios and exploiting short-term opportunities or opportunities brought on by short-termism. And then lastly, just on our performance, had to put it up. By and large, our equity portfolio is our flagship equity portfolio, and I think about 80% of the money we manage follows that mandate, and that has generally delivered well, those annualized returns. The balanced portfolios have done even better. Less money follows them, so it's less important from at least a client perspective. But nevertheless, strong relative performances. It must be mentioned, these are pre-costs performances. They're pre-costs because obviously we are a private client business and every client's costs differ, depending on when they came in, depending what their portfolio looks like, or depending on many reasons. Their costs differ. The average cost of our clients over many years has been just over 1%. I think it's 1.03%. So if you want to get a fair reflection of our performance relative to the all-share index, which is also pre-costs, remember, you can subtract 1% from our performance. If you subtract 1% from our performance when measured on a 10-year view, we'll rank in third place at the moment relative to the other players in the general equity unit trust. So by and large, we've backed this strategy, and by and large, it's worked quite nicely for us, and we're happy to stick with it. So thank you. That's my presentation. I just got some nice quotes. I think there are two elements to that. Firstly, the guys who are taking stick at the moment are the real strict proponents of value investing. They don't necessarily, in our mind, have enough perspective as to what the normal earning stream is. I mean, we looked at the most successful asset managers in this country, and generally speaking, the companies that have done well over a 10-year view are still doing quite well. Those which have employed a very strict criteria of value have been hurt because they looked at PEs, for example, of resources companies and saw that they were low, but didn't quite appreciate how much the earnings could collapse. So the perceived value was there, but it didn't actually realize. Remember, it relates to what I just said. They obviously have an estimation of what they believe SAB Miller to be worth. And, they profess to follow a value approach when they make decisions. So they would say SAB Miller is a good investment relative to the other alternatives out there. So I don't know because I don't come from that company, but I'm just hypothesizing as to what their thinking might be. They might have had quite a dim view on South African companies and said, well, the economic prospects are not great, hence companies who have invested or are heavily operational in South Africa won't grow well, and hence on a 5-year view, SAB might be expensive now, but on a 5-year view, doesn't look so expensive, and hence it demonstrates value on a relative basis, because asset management is always a relative game. You've got a certain amount of you've got a certain universe, a certain amount of constituents or shares in that universe if you've got an equity mandate, and you've got to play the relative game within those shares. I tried to answer that in the first question. I think they were a bit dogmatic on their value. They didn't incorporate enough what we call perspective, enough. I don't want to say they didn't have enough insights, but they obviously did a lot of work. It's a very thoroughly researched investment house, and they're generally held in quite high regard in the industry. They just haven't been able to put it all together. With the benefit of hindsight, they were way too heavy in resources and the like. So yes, those guys have been hurt. And as I said, we take a little bit of a different view in that we say we've got a value bias, but we certainly don't want to bet against a cycle. That's why we spoke about pattern. I alluded to pattern when I touched on to pattern, which is essentially alluding to the cycle. You generally don't want to be invested in the down cycle. The markets don't like that, generally speaking. And then it's the whole perspective thing. What's the shares through the cycle value? I think obviously if RECM would have it again, they would have definitely sat on the sidelines for a bit longer.